Markets are reeling after another inflation surprise. On today's show, we break down the numbers and their effect on portfolios. I'm Chris Roberts, and welcome to the Lowdown. Welcome in, everybody. I'm Chris Roberts, and as you can tell, I'm sitting in Mike Smith's seat here today. He's out of town, so I'm filling in for him today on the Lowdown. Joining me today is a new guest we haven't had on the show before, Andrei Costas. He's one of our portfolio managers here at Avidian Wealth Solutions. So welcome to the show, Andrei. It's great to have you on.
Thanks very much, Chris.
Well, look, Andrei, I thought I'd start with a little bit of a story here since it's my first time, hosting the show. So many moons ago, I hosted a radio program in my undergrad years called The Elephant in the Room. And I thought that was pretty, tangible for today's episode because you and I have been brainstorming about today's episode. We were thinking, let's focus on more long-term investment themes, things that, we could, talk about that weren't in the scope of what's happened over the last couple of weeks. And then, of course, this past Tuesday happened. We need to address the elephant in the room to bring that full circle. And so I really wanted to use today's show to focus on, the big inflation surprise, its effect on markets, and what have you. So I think first and foremost, I'm just going to run through the data. I know many of the folks watching this program have read it themselves, but let's just go through it, right? So August CPI was about 8.3%. Year over year, expectations were 8.1%. Month over month, we were looking for a negative 0.1% decline. We got a 0.1% increase. At least more importantly, in my view, core CPI rose 6.3% year over year and 0.6% month over month, where expectations were 6.1% year over year and 0.3% month over month, respectively. So, as a result, we saw really the biggest drawdown in markets that we've seen since June of 2020. And that sell-off really came off of what has been so far a pretty positive September. I think we kind of came back down there at about September 6th to September 12th. We had about a 5% plus rally. Mm-hmm. Gave all that back on Tuesday. And so while the sell-off was pretty jarring, we're still well off of those June lows. We're kind of trading in a channel now, if you will. But, why the sell-off? Why does this has happened before? And it's the same story, right? Inflation is the guidepost for Fed decision making, right? If inflation numbers miss, that means that, we're going to have more aggressive rate hikes in the future. We have the next Fed decision next week. I think CME Group put out this week that there's a now 20% chance for a full 1% interest rate hike, which would be pretty jarring. That would be the biggest increase in decades, to say the least. And so markets have to price in those new expectations. And, markets hate uncertainty, and ultimately uncertainty leads to volatility. And this year's been, full of uncertainty, so to speak. And then there's technical reasons for the sell-off. I think there was a lot of bullish momentum headed into, Tuesday's inflation print. A lot of people were kind of betting on a better report, maybe even inflation that came in below expectations, which would be a good thing. And so then you had a lot of leveraged positions out there, a lot of options trades put into place, and especially with institutions. And so we've had a lot of selling pressure all at once. And you had that capitulation. We've talked a lot about quantitative trading on this program a lot, and how that kind of just perpetuates volatility. But Andrei, I was thinking about this. And I said earlier that core CPI was really the more important figure in August. And I want to expand on that thought, see if you feel the same way, right? So core CPI, it strips out energy costs, which we know have been declining. If you've been to a gas station recently, I think I've got a gas station out in front of my neighborhood that was $4.30 for regular at one point. Now it's down to $3.19. But embedded in core CPI, one of the primary drivers behind the rise, at least, was the rising cost of both shelter and rents. All right, so now that we've broken down the data, I'm going to bring you in, Andrei. So, obviously that was a lot of information, but it's all very important information. And one of the key things that I said in there was that I felt that, the core CPI figure was really the more jarring piece there. Would you agree?
Yeah, when you look at, core CPI, stripping out, obviously, what you mentioned on the energy side, mm-hmm. We're definitely still seeing a relatively high inflationary environment. Mm-hmm. The same thing goes for the impact of food
Yep.
kind of across the
And
headline number.
And core, it strips out the food, but we with that at the same time, that's been a huge driver, and we're going to talk about that later in today's program. But we're going to flash a chart here, and I just pulled this data from the Fed a few days ago, and it was just the rapid increase in rents that we've seen really since the start of this year. We've got, this is a very short time horizon, but you can see it's pretty gradual up until about the start of this year, and I think ultimately, why that is rents lag behind property values, right? So, people got locked into, 1-2 year leases. And now that those property valuations have adjusted, and if I'm a landlord, I said, I don't care if rates have brought my property valuation down, I'm going to use that January 2022 peak to set my rent rates, so to speak. So, I want to kind of expand on that just a little bit. Obviously, I think that can potentially create some investment opportunities. And would you agree in that?
Oh,
front?
absolutely. Really, regardless of the type of environment that we find ourselves in, there's typically an opportunity, that either you can take advantage of if you have a long enough time horizon, or if you, think about things a little bit more tactically, you can certainly take tactical opportunities throughout an economic cycle.
Right. And we've talked a lot on this program throughout the year about the power of just having, uncorrelated assets in your portfolio. We've talked about alternatives. We even had one of our guests from ICAP on the show at one point. So that's, one of the ways we can take advantage of that is just things like multifamily real estate or uncorrelated assets, if you will, if that's a suitable thing for your portfolio. But, as we think about rent increases, what kind of catalysts are needed to normalize rent increases, would you say? I mean, what would you think on that front? Is it a supply issue?
Oh, it's definitely largely driven by supply. If you look, really since COVID broke out a couple of years ago, and with that supply shortfall, obviously we've seen upward pressure on pricing really for a number of months, post-pandemic. But now with the Fed really moving to raise rates, we're starting to see mortgage rates tick up above 6%. That obviously is impacting home affordability. And really the secondary impact of that is that anybody who maybe was thinking about moving into a new home, after a purchase is now rethinking those plans and maybe renewing leases and really driving demand on, the multifamily front.
So it's kind of a capitulation in itself, right? We have the rising rates. We have the rise in values, which already priced people out of the market. Now rates are up, and all that does is push or lock people into multifamily living arrangements, rental homes, rental duplexes, whatever it might be. And that in and of itself drives up rent rates in and of itself too. Because again, we have that limited amount of supply. And so, those are great points there, Andrei. And we're going to shift gears, just a little bit here. And, we're talking about inflation. Well, let's talk a little bit more about food, right? So we're going to throw up another chart right here. We're looking at food prices really since the start of 2020. And again, you see that same effect that you saw with rent too. Gradual increases until about the start of this year. And so, food costs were another big driver on the CPI surprise, right? While energy costs coming down really helped limit the upside surprise this last month, the food drivers are really intense right now. And so, for example, year over year, food at home, quote unquote, increased, 13.5%. That's the highest rate since March of 1979. Eggs increased nearly 40% year over year. And that's partially because of things really out of anybody's control. It's avian influenza earlier this year. The flu also impacted poultry production. So chicken prices are up 16.5%. Margarine was up almost 40% year over year last month. So we're seeing a lot of core staple goods. Really, it's not 5-6% increases year over year. It's 30-40% increases year over year. And so, and another really interesting data point I saw here, in prepping for today's show was, American families, they can save money by eating at home. And on average, eating at home is about 3.5 times less expensive than eating at a restaurant right now. And in my view, that's to some degree kind of a recession flag. Would you agree on that as well? Just people
absolutely.
Not eating out as much.
Yeah, absolutely. People are definitely feeling the impacts of supply chain issues, not only domestically, as we kind of hear about, things like the threat of a strike in terms of freight. Obviously that has been resolved, but, you still have the impact from expectations. Then you have Russia, Ukraine. They're major worldwide producers of things like wheat, And ultimately that all flows through, to us as a consumer, really globally.
Yeah.
I would say the other thing also to kind of keep in mind in terms of the food inflation side is, the tightness of the labor market. Obviously we're seeing a lot of tightness really across the board in terms of labor. That has driven up labor costs, ultimately producing food, sees those costs, having to flow through to the consumer. And so this really creates a really interesting dilemma, not only for the domestic economy, but also for the Fed, which now is in many ways backed into a corner, trying to land the plane, if you will, in a way that doesn't derail the economy, but also that addresses the inflation issues, which again are more supply side driven.
Well, exactly, Andre, and that was our next little segment here, which is we've talked about it on the show before this year, and we'll talk about it again. The Fed is trying to get inflation under control, but they increasingly cannot control these components, right? We talked about food and some of the drivers behind those food costs increase. Well, quite frankly, you can raise rates as much as you want, but people still have to buy butter. You still at some point have to buy some kind of a protein product or something like that. They may not eat out as much with credit card rates being higher and what have you, and money being tighter in general. But ultimately, they can only constrict the demand side of the economy so much, and they can't control the supply side drivers of inflation, the geopolitical and Russo-Ukrainian conflict drivers of inflation. And so again, I think what this comes back to, and something that Mike and I have talked about a lot this year, is it increases the likelihood that they don't land that plane, right? That, and unfortunately, we don't have that soft landing. We start complaining to the pilot, and I think we're already complaining to the pilot about that hard landing, right? So would you agree with that?
Definitely some concerns around that. Especially as we've seen, over these last couple of months, the Fed say, oh, we're kind of past peak inflation, we're going to see things moderate. And the magnitude of the moderation just hasn't been oftentimes what was really communicated. And so that's really a difficult thing from a credibility standpoint for the Fed to overcome.
So Andre, you said in that last segment right there, you said, hey, the Fed has really gotten kind of the peak inflation game wrong here, or their calls on when we're going to start seeing a retreat. And despite the fact that we had a surprise in August, we still have seen a gradual decline year over year in our inflation figures. It just was, above expectations, if you will. And we'll throw another chart up from the Fed here. Obviously, I love data from the Fed, as our viewers can see here. But you see the blue line here, that's just the CPI. That still came down month over month, I should say year over year, albeit a little bit more gradually. The red line is the core CPI, and that's where you can really bring in those rent increases, and that actually did increase year over year in August. But then we also talk a lot about inflation expectations too, and we'll throw that chart up as well, where, overall this year, inflation expectations have really gone off a cliff dive, right? And what do you think that's a sign of? Why are expectations diving so quickly, and while inflation is moderating so slowly?
Yeah, I really, when you look at this entire picture, a lot of it is really being driven by the fact that, inflation is largely affected by interest rate hikes. They've focused, almost exclusively on raising the short end of the curve. And, again, that's a demand focused tool. As you mentioned earlier, supply is really the major issue here. And so the question becomes for the Fed, what is it that ultimately can be done, to address those supply issues? What the Fed has in essence decided to do, throughout this process is try to hit the demand side, hard enough that ultimately you start to get an economic impact where demand actually catches up to much lower supply. And so really the danger there obviously is going to be painful, for us as we go through this process. So how much longer that persists, we still don't have a ton of clarity on, but certainly, through the rest of the year, we would expect the Fed to continue on this rate hiking path, until they do get inflation down again toward that 2% target inflation number.
Right, and those expectations coming down are really also a sign that, hey, people are feeling it, right? They're spending less, right? Those big purchases that a lot of people took advantage of during the pandemic. I mean, a lot of people moved and bought new homes, started building new homes, whatever it might be. A lot of that's rolling off, right? People don't feel that they can. That's typically what happens. Eventually, inflation runs so hot that it clamps the consumer on its own. It's a self-correcting philosophy in and of itself to some degree too,
Absolutely.
right? So, well, Andre, in wrapping up today's show, we want to talk a lot about, and we just talked about peak inflation, and we're going to throw up a chart that was actually in our most recent internal advisor meeting this month, and that is, historically, what headline index returns have been like after peak inflation. So, if we truly saw peak inflation earlier this summer, history tells us that there's some reasons to be bullish, I think, from this point. And when we're talking about opportunities, and, I thought it would be fun to talk a little bit about this topic since, you and I are definitely on the younger end of the spectrum, so to speak. I get questions all the time from our clients, especially amidst this volatile environment. They say, hey, how should my kids be investing in this environment? And ultimately, I say, look, they're in the accumulation phase. So long as they have, a stable job and they're contributing to their employer-sponsored plans, put money in the brokerage account every month. I mean, I think this is a great opportunity to dollar cost average. And that goes both for young clients and people who have cash on the sidelines. Ultimately, we've seen a pretty big retreat here. And it presents a value proposition, especially in, let's say, the growth sector that wasn't there before. I mean, would you agree with that statement?
Absolutely. I mean, you definitely have opportunities both on the growth side of the aisle, as well as even on fixed income. When you look at treasuries, we've seen treasury yields certainly move up considerably higher than we've seen, over the last couple of years. And so that is really an opportunity, for anybody that is maybe sitting in cash. As far as the younger demographic, I would definitely say that, as we always talk about, long time horizons can really be your friend. Periodic allocations across a well-diversified portfolio, equities and fixed income, geographically diversified as well. Again, making sure that you're trying to avoid some of those trouble spots geographically, which we see. Those are all wonderful opportunities as we do see much lower valuations as the Fed does raise rates.
Well, I'm glad you brought up diversification to kind of round out the program today, because I hear us, well, where everything's under pressure right now, and I think that's the broader point here, which is, at the end of the day, all asset classes have really been hit pretty hard, apart from maybe some energy stocks and what have you this year. So ultimately, I think there's a really good value proposition, like you said, both on the fixed income side and on the equity side, at least in publicly traded portfolios. And, for a long time, we've talked a lot about yield replacement and things like that. And so now there's actually an attractive opportunity in fixed income. And that should really be, confidence inspiring for a lot of people that are in that, distribution phase, who are trying to create those income streams within their portfolios. Well, Andre, look, I think this has been an excellent program today. I really appreciate you coming onto the Lowdown, and we'll see you next time.
Hey, thanks a lot for having me, Chris. I appreciate it, and we'll definitely look to see what happens with Fed policy moving through the end of the year.